In this video, we will discuss merchandising operations as well as briefly introduce the two systems that are used to account for inventory, a perpetual and a periodic inventory system. Subsequent videos will provide additional detail on both of these systems. REI, Walmart, and Amazon are merchandising companies because they buy and sell merchandise rather than perform services. Companies that purchase and sell directly to consumers are called retailers, whereas companies that sell to retailers are referred to as wholesalers. The primary source of revenue is referred to as sales revenue or simply sales. A merchandising company has two categories of expenses: cost of goods sold and operating expenses. Cost of goods sold is the total cost of the merchandise sold during the period. This expense is directly related to the revenue recognized from the sale of goods. Cost of goods sold is subtracted from sales revenue to arrive at gross profit. Gross profit represents the merchandising profit of a company. Because operating expenses have not been deducted, it is not a measure of the overall profit of a company. The items in the two blue boxes are unique to a merchandising company. They are not used by a service company. The operating cycle of a merchandising company is typically longer than that of a service company. The purchase of inventory and its eventual sale lengthen the cycle. This slide shows both the operating cycles of a service and merchandising company. Note that the added asset account for a merchandising company is the inventory account. This slide illustrates the flow of cost for a merchandising company. Beginning inventory plus the cost of goods purchased equals the cost of goods available for sale. As the goods are sold, they are assigned to the cost of goods sold. Those goods that are not sold by the end of the accounting period represent our ending inventory. I want you to think of if the product is sitting on the shelf, it is sitting or residing in our ending inventory. If, however, we sell the product, then we're going to assign that cost to the cost of goods sold. Companies can use one of two systems to account for inventory: a perpetual inventory system or a periodic inventory system. If we were in the classroom, I would illustrate this concept with candy bars, Monopoly Money, and 7-Eleven. My top 4 performers on the first exam would be given play money along with their exams. I would ask the class to pretend my table represents the checkout counter at 7-Eleven and it contains 5 candy bars. I want you to think of the 5 candy bars as our beginning inventory. Right? During that accounting period, we purchase an additional 5 bars, so now we have 10 available to sell. My top performers are then asked to buy a candy bar, so I sell them 4 candy bars, which leaves me 6 in my inventory. Let's assume, to keep this simple, that each candy bar cost $1. Right, so again, we have $5 in our beginning inventory. We add an additional $5 of purchases, so we have $10 worth of goods available to sell. We're going to assign $4 to our cost of goods sold, which means our ending inventory is valued at $6. Let's also assume that we sell these candy bars for $2 each. So we are going to generate sales of $8. Again, the 4 candy bars times the selling price of $2. We're going to subtract our cost of goods sold. Again, we identified that as $4 to arrive at gross profit. And again, gross profit is simply the difference between our sales and our cost of goods sold, and it represents that merchandising profit. Again, it doesn't represent our overall profit or net income because we still have to cover our operating expenses, such as our rent and our utilities and the salaries of the employees that work for us. In a perpetual inventory system, companies maintain detailed records of the cost of each inventory purchase and sale. These records continuously or perpetually show the inventory that should be on hand for every item. A grocery store uses both barcodes and optical scanners to keep a daily running record of every product it buys and sells. Under a perpetual inventory system, a company determines the cost of goods sold each time a sale occurs. The seller makes 2 entries for each sale. The first entry records the sale. The seller increases or debits cash or possibly accounts receivable if it's a credit sale, and also increases or credits sales revenue. The second entry records the cost of the merchandise sold. The seller increases or debits cost of goods sold and also decreases or credits inventory for the cost of those goods. As a result, the inventory account will show at all times the amount of inventory that should be on hand. In a periodic inventory system, companies do not keep detailed records of the goods on hand throughout the period. They determine the cost of goods sold only at the end of the accounting period, that is, periodically. At that point, the company takes a physical inventory count to determine the cost of goods on hand. To determine the cost of goods sold, we start with the cost of goods on hand at the beginning of the period and add the cost of goods purchased to arrive at the cost of goods available for sale. We then subtract the cost of goods on hand at the end of the period, which is our ending inventory, to arrive at our cost of goods sold. The ending inventory is determined by a physical inventory count at the end of the accounting period. In this example, the ending inventory is valued at $125,000. Companies that sell merchandise with high unit values, such as automobiles, furniture, and major home appliances, have traditionally used perpetual systems. The growing use of computers and electronic scanners has enabled many more companies to install this inventory system. This system is so named because the accounting records continuously or perpetually show the quantity and the cost of the inventory that should be on hand at any time. This system provides better control over inventories than a periodic system. Since the inventory records show the quantities that should be on hand, the company can count the goods at any time to see whether the amount of goods actually on hand agrees with the inventory records.